If you thought a Federal Reserve rate cut would send Treasury yields tumbling, you might be in for a surprise. Despite the Fed finally pulling the trigger and lowering interest rates, bond yields have actually ticked higher, leaving many investors scratching their heads and rethinking their next move. Let's break down what's happening here and why it matters to anyone with a 401k, mortgage, or even just a checking account. The Federal Reserve, which is basically America's central bank, made headlines by lowering its key interest rate, a move that's usually meant to give the economy a little boost. Lower rates typically mean it's cheaper to borrow money for things like homes, cars, or business expansions. And usually, when the Fed cuts rates, Treasury yields, the interest the government pays to borrow, drop as well. But this time, the opposite happened. Right after the announcement, Treasury yields started climbing. Now, at first glance, that seems backwards. After all, if borrowing is supposed to get cheaper, why would the yield on a 10-year Treasury bond go up instead of down? The key to this puzzle lies in what Fed Chair Jerome Powell said after the rate cut. Powell made it clear that this isn't the start of a rapid-fire series of cuts. In his words, the Fed isn't in a sprint to loosen monetary policy. Translation, they're not planning to slash rates again and again in quick succession. Instead, Powell and his team are taking a wait-and-see approach, making adjustments slowly and carefully based on how the economy responds. This measured pace caught some investors off guard. Many in the bond market were betting on a much more aggressive series of cuts, hoping for a quick drop in rates that would push bond prices up and yields down. When Powell poured cold water on those expectations, traders had to recalibrate their strategies in real time. Let's talk about why this matters. First, a quick refresher. Bond yields and prices move in opposite directions. When yields go up, prices go down, and vice versa. So, when investors realized that rate cuts would be slow and steady, they started selling off some of their treasuries, driving prices down and yields up. Why such a strong reaction? Well, the bond market is incredibly sensitive to Fed signals. Even a hint that policy might stay tighter for longer can send shock waves through the system. And with trillions of dollars at stake, those shock waves can ripple out to affect everything from mortgage rates to stock prices. To put this into perspective, let's look at some numbers. Before the Fed's announcement, the yield on the 10-year Treasury note was hovering around 4.2%. After the news broke, it jumped closer to 4.4%. That might not sound like a huge move, but in the world of government bonds, it's significant. These are the benchmarks for a lot of lending and investment rates across the economy. So, what's driving the Fed's cautious approach? Inflation is still running hotter than the central bank would like. While it's come down from the red-hot levels we saw post-pandemic, it's not quite back in the comfort zone. The Fed's mandate is to balance keeping prices stable with supporting maximum employment, so they want to avoid cutting rates too quickly and accidentally reigniting inflation. There's also the bigger picture to consider. Historically, the Fed has sometimes been accused of moving too fast, either cutting or hiking rates without letting previous moves play out. In the 1970s, for example, policymakers repeatedly slashed rates to fight unemployment, only to see inflation spiral out of control. Powell seems determined not to repeat that mistake, preferring patience over panic. For everyday investors, this has a few important implications. First, if you're in the market for a mortgage or car loan, don't expect rates to drop dramatically overnight. Lenders take their cues from both the Fed and the bond market, and right now, both are signaling caution. Similarly, savers who have enjoyed higher yields on things like CDs and savings accounts might see those rates stick around a bit longer. In the stock market, the reaction has been mixed. Some investors worry that higher yields could put pressure on stocks, especially those in sectors that are sensitive to borrowing costs, like real estate and utilities. Others see the Fed's caution as a sign that they're committed to keeping inflation under control, which could be good for long-term growth. Looking ahead, all eyes will be on economic data. If inflation cools further and the job market stays healthy, the Fed could feel comfortable cutting rates again later this year. But if prices stay sticky, or if there are signs the economy is overheating, they might hold off. It's a delicate balancing act, and the bond market will be watching every move and every word out of the Fed. One thing's for sure, the days of ultra-cheap money are behind us, at least for now. For investors, that means a return to more normal conditions where careful analysis and smart positioning matter more than ever. Whether you're thinking about refinancing your home, buying stocks, or just trying to grow your savings, keeping an eye on the Fed and the bond market is crucial. If you found this breakdown helpful, don't forget to like, comment, and subscribe. I'd love to hear your thoughts. Are you surprised by the bond market's reaction, or do you think the Fed is playing it right? As always, stay informed, stay curious, and remember, in the world of finance, today's moves set the stage for tomorrow's surprises.